Well, joining me this morning is David Ivan Wangol. Good morning, David.
Good morning, how are you?
Are you in the new year mood?
Yes, it's certainly a new year. 2014 in itself was not a bad year.
Was it good in the investment market?
It was quite an opportunist year in the investment market. A couple of investments have been made. There's optimism, particularly in the East African context. So
that's a wider market.
That's the wider market that we're looking at. So I would imagine whatever is happening in Kenya should be trickling down to Uganda, should be happening in Tanzania, Rwanda, and a lot has been done, you know, just to put the process of, you know, the East African context and investments at the forefront. Things such as the standard gauge, you know, driving the optimism. So there should be you know, quite a prosperous 2015 in my opinion. That's
awesome. Well, speaking of investment, we've had a lot about private equity investments, where we, of course, our best examples are not unfortunately in Africa. We were looking to the US. By definition, what is private equity investment?
Private equity, from an investment professional way of looking at it, is an alternative asset of investment. And by alternative meaning outside the traditional investments such as bonds and public equity. So it's an alternative asset from an investment perspective. But in layman's lingo, it probably is something they call venture capital. It's probably something they call seed capital. It's probably something they call growth capital. So it is really capital designed to buy equity into a business without going through the public markets, hence the word private equity. And this capital then serves different purposes depending on the level and stage the businesses are.
Is it harder to go through the public market or the private? Because I'd imagine, of course, the public has lots of
yes, exactly. That's really the reason. Because of the process in the public markets and the required regulatory requirements, the existing history of the business and the structures of the business, you find that most ideas are funded through private process before then they are taken to the public market, where the exits, you know, are realized for the initial, you know, private investors. So that's really the train of private equity investment, then to the public markets, you know, to realize the investment. Sometimes they usually come back even from the public markets back to the private, but the traditional route is to, you know, take them from, you know, right from the idea stage, then through to the public markets for the exit.
As an investor, do I just jump in, or they're actually specific that you as an investment manager limit me to as a, this money of yours, I think you need to go to this particular segment, or this is not defined for you, you need to hit a certain amount of investment to be able to be a part?
Well, given the setup of private equity investment, it is long-term and patient capital, so it really requires a lot of high net worth you know, individuals or institutional investors coming together. They come together and form what we call a fund. And they are the limited partners in the fund. Then they hire a fund manager who's the general partner in the fund, okay? And the fund manager now manages this fund on behalf of, you know, a group of investors, institutional investors, deploying capital as the initial mandate of those investors. Of course, now, given the long-term nature, it really limits the number of people that you know, the number of people that can participate effectively, you know, in the long-term sense. And so once this fund is set up, you know, there are so many independent committees set up around the fund so as to separate the fund manager from the asset. But the fund manager manages the asset, supervises the business and the businesses that are invested in on behalf of the investors, and after a period of time returns the capital, you know, to the investors, you know, once the harvest period, you know, has been
strict accountability measures.
Yes, strict in the sense that it's fiduciary in a sense, because you know, this is money that is out there to be returned, but it's then very advantageous money because of its long-term nature, as I said, and probably we'll get to that as I, you know, closely define, you know, some of the value and advantages of private equity versus other, you know, forms of capital. And given that it's a form of capital that has to make a return, there's a lot of fiduciary responsibility that must be, you know, held up there.
Let's just go to the distinction between that private equity and you know, other forms of funding?
What private equity is, as I said, it's private, meaning a group of investors come together for their own reasons and purposes to invest the money in equity. By equity, I mean buying actual stakes or stakes in businesses. That differs from debt, for example, where, you know, we go out to commercial banks that have collected deposits from the public
and we seek a loan.
And seek a loan. It differs from the stock market, the Uganda Stock Exchange, for example, where companies come to sell their shares and seek, you know, they invite the public to participate. Yeah. So in this sense, it is a group of private investors with a desire or intention on how to use their funds, then seek to invest that money in specific businesses that they would have identified with no really regulatory control around the particular portfolio companies that are being invested in, apart from the advisory, independent advisory boards that supervise the way the fund is being managed. So
ideally they would just say, oh, we have 10 billion shillings, we want to invest in NTV. Let's sit on a table. We'll see if you can invite us in. That is the lowest end of private equity. And in that stage, you probably have an individual too who have a close relationship with who is the management of NTV. At the higher end, we have structured fund managers or structured fund managers who are out there constantly seeking investments to make on behalf of a group of investors. That's you. Yes, and that is who we are. Okay. That's who Pearl Capital Partners is. So we manage a fund on behalf of a group of investors who have set up this fund and given us the mandate to manage it according to certain parameters that are set out right at the beginning over a given time horizon. Is it at the same level? Because if you see like the investment that the Warren Buffetts of this world, Bush, the investment that the Bono, the investment that they do, is it at the same level? Or theirs is at a... Yes and no. These are different vehicles serve, you know, almost serve the same purpose, but they are formed for different reasons. For example, Warren Buffett runs an investment company, an investment holding company. It is the same as private equity, but it's for different reasons that he runs it as such, probably for closer control on the investment decision and process through the principal himself. Then you find people like Bono without any experience in investing, but with interest, say in poverty in Africa, will create a fund and then have people come and invest. You have people like Bill and Melinda Gates Foundation, you have people like Rockefeller, Gatsby, who with an interest, you know, in Africa or in certain sectors such as health or agriculture, you know, will go out there, set up funds and then find qualified fund managers or people with what more local knowledge or existing knowledge about the industry to invest this money on their behalf. That is also the other way. Or you have an individual with a specific interest in technology and just seeks out, you know, individual ideas or investments to make in the technology sector, something that is quite common in Silicon Valley, where, you know, you have what we call angel investors or, you know, individual investors looking for, you know, ideas to invest in. So it's at different levels and for different reasons that these structures are formed. Right. Yes. Let's localize it. Yes. Let's localize it. We are talking about the East African. Yes, the East African context. So within the East African context, for example, Pearl Capital Partners is a regional fund manager that invests in East Africa. So we have quite the experience, you know, to look at the region, and we are specific to the agro sector, which again is informed by the kind of investors that have invested in the fund. Just to give you the background, we have the Rockefeller, Gatsby, Bill and Melinda Gates Foundation, JP Morgan Social Finance, with support from you know, USAID, coming together to set up, you know, a fund, a $25 million fund, and the purpose of this fund is to invest in agribusinesses, SME agribusinesses, to a tune of $500,000 US, 2.5 million US. So that is the initial mandate, and the mandate is to invest in the businesses for growth first and foremost, and again invest in businesses that focus on sectors that bring in smallholder farmer networks. So this is where now the benefit to the you know, the individuals and the entrepreneurs is. So at the fund level, it is an institutional case, but now at the portfolio level, at the investment level, then we have entrepreneurs that we approach and you know, go through a process of due diligence, finding out why they need the capital, understanding what is their growth
you know, growth plan, you know, where they want to go. Is it a succession issue? Is it an issue of finding a strategic partner? You know, we must discuss right from the beginning when the capital is deployed up to the end of when the capital, you know, is removed. And, you know, this capital is 5 to 7 years. We have been given a mandate to manage it for 5 to 7 years. So it sits in the business and, you know, does not take out money from the business, say the way, you know, debt is taken out. So the private equity fund manager, such as PAL, then going through that process of due diligence, then makes the investment on behalf of the investor and, you know, takes steps to protect that investment, you know, through, you know, sitting on the board, you know, having shareholder reserved matters, which they must make decisions on that are privy to them, you know, aligning interests, you know. By aligning interests, I mean you want the promoter and yourself to be, you know, equal, you know, well compensated, because they are putting in the sweat, you're putting in the capital. But at the end of the day, you must make sure that they feel that they are, you know, benefiting out of this relationship, because
not just you investing money.
So how do we then add value? You know, we must be able to advise on strategy. We must be able to sit on these boards and advise on corporate governance and transparency, because that helps a lot in exits. We must be able to identify partners, financial partners, say banks, leverage within our networks, you know, to help them access money. We must be able to, you know, inform controls and systems and put systems in place. We must be able to have a network of people.
It sounds like, what you're telling me sounds like you are literally running the entrepreneur's business.
We must run it, but we run it from a strategic level, which is at the board. So we create an environment where there is structure. These businesses, you must understand, are small SME businesses where the kitchen, the kitchen is the decision-making table. So therefore, we try to take that decision process out from the kitchen, you know, into a room where, you know, minds with a similar goal in mind at the end can start to make decisions right from the outset. It's not easy, but that is really the intention. So as a private equity fund manager, you must be very careful. How are we adding value at the board level? What are we helping the company achieve? The initial business plan that the promoter had in mind, how is that translating on a daily basis, on a monthly basis, on an annual basis? And are we getting towards the goal that we built up? Because at the end of the day, if that relationship is not built around the initial idea, or that relationship is not built around the logical, what I would call the logical aspects of what we can, you know, see, add or subtract from the business, then we may not achieve, you know, the return back to the investors that, you know, that is the initial mandate that the fund manager has.
From the obvious benefit of me, the entrepreneur, getting enough funding for my business, what value? How should entrepreneurs use that opportunity? For example, how can they even seek that opportunity for private equity investment?
Yes, as I said, private equity investment is relationship-based investment, so to speak, because you know, you must base your engagement on an existential relationship of where, as partners now, we can work together on a strategy for the future. And there's so many reasons promoters will come to you. It could be that they want to grow the company. It could be that they want to sell the company at some point. It could be that there are succession issues that they need to address at some point. So they bring in somebody with the competence to engage, to really engineer that process. And that is a real value add that can only be seen at exit. But it works on a daily basis. And what do I mean by a daily basis? We must be able to identify partners for this business on a daily basis. They might be workers in the company, they might be board members with industry knowledge, or they might be consultants who improve operations within the business. So that we must be able to have as part of our value add. We must be able to identify partners who can, you know, take on these businesses at some point in exit. So we must be able to identify what were the existing, what was the initial intention of the promoter. Did he want to have a strategic partner join his business when it has reached a certain size? By strategic partner, I would say for intention. So as a private equity fund manager, you must be very careful. How are we adding value at the board level? what are we helping the company achieve? The initial business plan that the promoter had in mind, how is that translating on a daily basis, on a monthly basis, on an annual basis?
Right.
And are we getting towards the goal that we built up? Because at the end of the day, if that relationship is not built around the initial idea, or that relationship is not built around the logical, what I would call the logical aspects of what we can, see, add or subtract from the business, then we may not achieve, the return back to the investors that is the initial mandate that the fund manager has.
From the obvious benefit of me, the entrepreneur, getting enough funding for my business,
yes,
yeah, what value? How should entrepreneurs use that opportunity? For example, how can they even seek that opportunity for private equity investment?
Yes, as I said, private equity investment is relationship-based investment, so to speak, because you must base your engagement on an existential relationship of where, as partners now, we can work together on a strategy for the future. And there's so many reasons promoters will come to you. It could be that they want to grow the company. It could be that they want to sell the company at some point. It could be that there are succession issues that they need to address at some point. So they bring in somebody with the competence to engage, to really engineer that process. And that is a real value add that can only be seen at exit. But it works on a daily basis. And what do I mean by a daily basis? We must be able to identify partners for this business on a daily basis. They might be workers in the company, they might be board members with industry knowledge, or they might be consultants who improve operations within the business. So that we must be able to have as part of our value add. We must be able to identify partners who can, take on these businesses at some point in exit. So we must be able to identify what were the existing, what was the initial intention of the promoter. Did he want to have a strategic partner join his business when it has reached a certain size? By strategic partner, I would say, for example, if we have a small hotel, okay, trying to grow, and then needs probably Serena Hotel to join, to merge into it, it might invite a private equity partner who then injects money into that business
to get to the level where they
get to the level where
an affiliate of Serena.
Yeah, not a level per se by money terms, but to a level of transparency, structure, corporate governance, operational excellence, these kinds of things that define corporate excellence or corporate structure excellence. And then be able to invite external partners to join the business. Right. So private equity kind of shapes, for example, especially for the SME concept in East Africa, it shapes the businesses and gives them a structure and gives them the opportunity to access bigger sizes of bigger markets, bigger sizes of capital, and bigger partners for growth. So it is really an engine for growth, and that is what drives the relationship, and that's what should drive the relationship between the private equity fund and the existing businesses that are seeking this kind of opportunity.
Right, David, thank you so much for giving us this brilliant advice. All entrepreneurs, please log on to our Facebook page, and we'll be uploading this clip. You can get more of that and then continue the conversation. What's the contact of Pearl Capital, so that
Pearl Capital Partners has 2 operation offices in Kenya, Nairobi, and in Uganda here, Kampala. Our office in Nairobi is on Riara Road, Corporate Suites. Our office in Uganda here is the Uma Showgrounds, Equator Isle.
Right.
So even our website, pearlcapitalpartners.net, is accessible. You'll be able to see what we do, who we've done it with in Uganda, that's an important reference, a reference check for many entrepreneurs, and then particularly in a sector like agro, where traditionally bank loans have not been accessible. It gives us, it gives you a good idea of the possibilities, in private equity that do exist.
That's true.
Yeah.
Well, David, many thanks again for coming. Go to our Facebook page, Morning at NTV, and let's continue that conversation there. You can also tweet us at Morning at NTV.